Welcome to The Explainer. Today, we're going to unpack a moment that represents a seismic shift in finance. It's a move that doesn't just cause a tremor, it fundamentally changes the entire landscape. And it all kicked off with a single, simple filing. Yup, you heard that right. Morgan Stanley, one of the absolute giants of wealth management, has officially jumped into the ring. And they didn't just file for a Bitcoin ETF, they filed for a Solana ETF too. Now, this isn't just another company launching another product. This is a statement. This is a sign that the entire game has changed for good. So you have to ask yourself, what's the big deal here? Is this just another fund we're talking about, or is this the first shot in a full-blown financial revolution? Well, to really get the answer, we have to look at how Wall Street's entire role is changing, from being just a gatekeeper to becoming the owner of the whole factory. Let's dive into what that really means. This move is a complete strategic pivot, a total 180. For years, the big banks just kind of watched from the sidelines, right? They cautiously let their clients dip a toe into crypto, but only through products that other companies built. Now they're building the products themselves. And the difference is just night and day. If you look back to 2024, when the first Bitcoin ETFs launched, the banks were just distributors. They were passive middlemen, basically storefronts. But you fast forward just 2 years to 2026, and suddenly they are the factory. They're the issuers, the manufacturers. They've gone from just selling crypto to designing, owning, and profiting from the entire process. So what on earth made this happen so fast? A giant like Morgan Stanley doesn't make a move this big unless the path forward is perfectly clear. And the answer lies in a handful of really crucial regulatory changes that all went down in 2025. And look, this wasn't just one thing. It was like a series of dominoes, all falling perfectly into place. First, you get the initial Bitcoin ETFs approved in early 2024. That cracked the door open. Then, in mid-2025, a key law called the Genius Act passes, which cleared up a ton of legal fog. And the final piece of the puzzle came later that year, when regulators created a sort of fast track for these new products. One by one, they just systematically removed every single roadblock that was keeping Wall Street out. So the key takeaway here is that regulators didn't just open a door. They built an 8-lane superhighway, put up all the green lights, and basically told Wall Street, the road is all yours. All that uncertainty that kept them on the sidelines for years, poof, it was gone. So let's see what kind of new things they started building once they got that green light. Now here's where it gets really interesting. Morgan Stanley isn't just copying what's already out there. They're actually innovating. Their Bitcoin ETF is, pretty standard stuff. But their Solana ETF, well, it introduces a feature that is a genuine game changer for this entire asset class. See, the Bitcoin Trust is what finance folks call a zero-carry asset. It just tracks the price of Bitcoin. It doesn't earn you anything on its own. In fact, after fees, it actually costs you a little bit to hold it. The Solana Trust, though, is a totally different animal. Yeah, it tracks the price of Solana, but, and this is the key part, it also generates its own income. It transforms a crypto asset into something that acts a lot more like a dividend-paying stock. So how does it do that? It's through a process called staking, and it's much simpler than it sounds. Basically, the fund takes the Solana tokens it holds and puts them to work helping to secure the network, verifying transactions, that sort of thing. And in return for doing that work, the fund earns rewards. Honestly, it's a lot like earning interest in a high-yield savings account. And this chart right here shows you exactly why that's such a big deal. A Bitcoin ETF has a yield of 0, minus fees, so you're in the red. But with the Solana ETF, you start with a staking reward of around 5 to 7%. Even after you subtract the management fee, investors are left with a positive net return. It's called positive carry, and it means you can actually make money even if the price of Solana doesn't move one single inch. That's huge. Okay, let's step back for a second. Why go through all this trouble? Why build your own products when you could just keep selling the ones from BlackRock? Well, the answer really pulls back the curtain on Wall Street's true playbook here. And believe me, it is about way more than just a new fund. First and foremost, you just have to follow the money. Morgan Stanley manages over $6 trillion in client assets. So let's say just a tiny fraction of that, 1%, flows into their own crypto products. At a pretty conservative fee, they stand to make over $160 million in new revenue every single year. That's money that used to go straight to their competitor. It's a classic business move. It's called vertical integration. Step 1, you already control the distribution channel with your army of 15,000 plus financial advisors. Step 2, you build the factory yourself to manufacture the product. And step 3, you internalize all the profits. They own the sales force, and now they own the product. They capture the entire value chain from start to finish. But it's about so much more than just the fees. This is a defensive play to keep their clients' money inside the Morgan Stanley walled garden. It's an offensive play, too. They can use those staking yields to offer products with zero management fees. How do you compete with that? And maybe most importantly, this is about data. When you own the fund, you see all the trading flow, giving you an incredible intelligence advantage in a brand new market. So you have to understand, Morgan Stanley just fired the starting pistol in a race, and it signals the beginning of a mad dash across all of Wall Street and a fundamental shift in how crypto is viewed as just another piece of a normal investment portfolio. You know, they actually laid the groundwork for this back in late 2025. Their global investment committee did something huge. They officially reclassified crypto. It stopped being this weird, speculative other thing and became a publicly traded real asset. That puts it in the exact same bucket as things like gold, oil, and real estate. And that simple change in classification led to a massive change in their investment advice. And here it is, the 4% rule. For the first time ever, they are formally recommending that clients with more aggressive portfolios allocate up to 4% to digital assets. Even a balanced growth portfolio gets a 2% recommendation. This is no longer some fringe idea. It's official guidance that could unlock tens of billions of dollars in new investment from their clients alone. And this is not going to stop with Bitcoin and Solana. Industry experts are already calling 2026 the year of the ETF Palooza. With the regulatory path clear, get ready for a whole wave of new filings for other major digital assets. We're talking Ripple, Chainlink, Avalanche, you name it. Wall Street is about to package up the entire crypto market for mainstream investors. The scale of this is just staggering. Analysts are projecting that this flood of new products, led by firms like Morgan Stanley, will drive over $50 billion of net new money into crypto ETFs in 2026 alone. For years, people have talked about the institutional wave coming to crypto. Well, it's finally here. So what this all really means is that the center of gravity in the crypto world has officially shifted. For years, the most important document for a new project was its technical white paper. Now, the most important document is its S-1 filing, the registration form you file with the SEC. The power has officially moved from the coders in Silicon Valley to the bankers on Wall Street. And that leaves us with the ultimate question. For a decade, crypto promised to disrupt traditional finance. But now, traditional finance is absorbing crypto. So as these two worlds finally and fully merge, who is really changing whom? Is Wall Street going to tame crypto and make it just another asset? Or is crypto's decentralized DNA going to fundamentally reshape Wall Street from the inside out? That is the multi-trillion-dollar question we're all about to see answered.